Hey everyone, in today's video, I'm going to be going through an update on my $272,000 dividend stock portfolio here. We're going to start with just an overview of this portfolio, how it's been doing, what positions I still hold in it, before diving into some recent buys I've made and how this portfolio has looked different so far in 2024 based off of the positions I've been buying and selling. Overall, over the last 3 to 6 months here, the portfolio hasn't been moving too much. You can see it was at about $260,000 to start the year. Since then, I've put in about $6,000, $7,000, and the portfolio is up about $10,000, $12,000 overall. So a couple percent up, but not anything significant so far this year. Longer term, in the last 1 year, I think I'm up about 7% after net deposits, and then all time, which is about 2.5 years at this point, up about 14%. So nothing crazy, but not doing too bad here. Going through the kinds of stocks I hold here in my non-registered account, lots of dividend stocks. That's really the focus of this portfolio. You can see here lots of REITs, royalty funds, utilities as well that I own in here. Some big tech that you'll see me get to here with Google, Microsoft, Meta, and then some consumer staples, Coca-Cola, P&G, McDonald's, etc. So a good portfolio of diversified, primarily dividend-paying companies, with the exception of maybe Google and some of those big tech companies that don't pay a big dividend. And then recently, we'll get into it a bit later, but I've added a lot more ETFs to my portfolio with like the S&P 500 and some international ETFs as well. So overall, you can kind of see in terms of absolute performance in this column here, I have some stocks that are down pretty big. Most of them are REITs. Northwest Healthcare had a lot of challenges, down 60% still. Allied, which is an office REIT, down 33%. But I think lots of it is still around sentiment, and they do have some headwinds ahead of them. But I think the stock price on some of these names are a bit overblown. Taking a look at Allied here as an example, currently trading at about $17.50 a share. Just had a huge up day actually, but about $17.50 a share. And they've been doing over $2 a year in funds from operations. So we're talking about a stock trading about $8 or 8 times funds from operation. They have tons of downtown exposure in their real estate, some great real estate across Canada. And yeah, they're in the office space, but at some point, the valuation has already come down so far. They used to trade at around 20 times, low 20 times multiples pre-pandemic. I know interest rates have gone up, which is downwards pressure on REITs cash flows at large, and then obviously some more fundamental risks on the office side. But I think with the quality and flagship assets that they own, I think they're trading at a pretty attractive valuation, all things considered. With that being said, I still don't want this to be a huge part of my portfolio, just given that there are some risks there. So it's not a huge position, about $4,000, so about 1.5% of this account specifically. But just one example where I'm down big, but I truly don't believe that the company is necessarily trading at fair value. You see some of these other names here on the other side that have done really well for me. I've Meta, Microsoft, Google, all of my big tech companies, fintech too, I guess you can throw in, are my largest gainers as the market's been just going up like crazy the last 1-2 years. And obviously that's been mostly driven by the NASDAQ and tech companies. Even though this is primarily a dividend portfolio, I really didn't want to miss out on some of those opportunities. So really glad that I still was able to carve out a bit of a position in some of these names. And when it comes to companies like Microsoft and Google here, these are pretty big positions, over $10,000 or $11,000 US on the Microsoft side, over $9,000 on the Google side. Visa, they're over $12,000. So those gains have really helped propel the capital appreciation of my portfolio. Some nice double-digit gains here on my dividend growth stocks like CN Rail, P&G, McDonald's, S&P Global as well, which is nice to get that capital appreciation in addition to the dividend yield. So that's just a bit of a feel for my stock portfolio here. diving into some things that I've been buying recently here, and also some strategy changes for 2024. So I did a video at the beginning of 2024 just on some strategy changes that I was looking to make throughout 2024. And one of the big things was getting more broad market exposure through ETFs in my portfolio. So I've done that through a handful of ETFs. The first one here is just an S&P 500 ETF, ticker VFV. So this trades on the TSX. So I don't pay FX fees necessarily. And if I look at the S&P 500 over the last 5, 10 years and longer historically, it's been a great performer. Just a lot of really great companies, and it's really hard to own them all, obviously. So by owning just an S&P 500 index, you get general investment in profitable, large U.S. companies that tend to just perform really well. It's a bit of a cheat code if you're a long-term investor. I'm still pretty young, going to be investing for a long time. So I thought, it's a missed opportunity given my time horizon not to at least have some diversification in the S&P 500. So I just started this position pretty recently, only up to 14 shares, but every now and then I throw another share in there, and I want to build this up to a much larger position over time. Don't really care about the dollar cost averaging at these levels, because I plan to hopefully hold a position in the S&P 500 for many, many years to come. I also acknowledge that when I look at my portfolio, it is a lot of Canadian exposure, and what's not Canadian exposure is primarily American exposure. So I made a couple investments in other areas of the world more deliberately. One of them here is a ticker called VPL. This only traded on the US stock exchange, so I did have to pay FX fees to get this money over. VPL is a Pacific ETF. It's like 70-75% Japanese equities, and then the other 25% is split between countries like South Korea, Singapore. I think there's some Taiwan in there and whatnot. So primarily a Japanese market index with some of the surrounding countries as well, maybe a couple percent Australia. But that's just because even lots of the American companies I own have big presences in Europe, but I feel like they don't have the same reach or the same market shares or exposure to the Pacific region of the world. So just globalizing my portfolio a bit, I looked at a bunch of different options, thought this was a good option to invest in here. If I'm going to go, just checking. Okay. If I'm going to go into the yield here, it's about 3.2% dividend yield that this one pays me. So in addition to getting that diversification, also getting a nice dividend yield as well to hold on to this one. And then the next global ETF that I've been adding to my portfolio here is a bit wider of a net. It's ticker VWO. This one here is an emerging markets ETF, so they own Chinese stocks, Brazilian stocks, Indian stocks, along with a lot of other emerging markets, but those are kind of the big ones. I think it's China, India, Brazil make up 60-70% of this ETF here. So same logic as VPL, just don't really know or don't think I get tremendous exposure to countries like India, or lots of my US companies are kind of boxed out of China. So this is a way to get some level of exposure, even though it's not a great amount of exposure at the end of the day in terms of percentage of my portfolio, which I'm okay with, because at the end of the day, the US market and the North American market has outpaced lots of these markets over long periods of time. Going into some other buys that I've been making in my account here. And just before going into that, wanted to share just like S&P 500 for those of you who are a bit less familiar, some of the attributes and companies that are weighted in there. So lots of big tech at the top: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet. Those make up, a good quarter, give or take, of the S&P 500. But then there's a really long tail. So you get companies like Berkshire, Eli Lilly, Broadcom. It goes on and on as in terms of the top 500 companies in the U.S. So you're getting a great amount of really good, strong US profitable companies here, all under one ticker. Some other stocks that I've been buying, Coca-Cola has been one on the US side. It's been pretty stagnant over the last year. You see here it's actually down 5% over the last year. But long term, this one's performed really well, getting a starting dividend yield of 3.1%, and they've been able to increase their dividend year over year for 50 plus years. So feel pretty safe with that 3.1% starting yield. I really wanted to get to 250 shares, so it's a pretty big position here, about 15,000 US dollars, 20,000 Canadian dollars, give or take. Still about flat on it, which is fine. I've started getting some dividends, some pretty nice dividends in from this one on a quarterly basis. This is one I'm good to hold for the long term. Really like their market position on the beverage sides, really like their global reach and the different categories within beverages that they play in. So this is one that I think they're going to become a lot more asset light over the next few years, a lot more cash flow to buy back shares, to make M&A decisions and whatnot. Right now they're trading, if I look at their price to earnings ratio here, sitting at about $2.90 for next year. So around 21 times earnings at these levels. I think that's fair over the long term for a business like Coca-Cola. Some other companies that I've been buying recently, going over to S&P Global, added a couple S&P Global shares on a recent little dip here, going over the last 3 months maybe. You can kind of see had a bit of a down or a dip into the high teens. Long term, this isn't much of a dip. The company's done really well, up 100% over the last 5 years, but thought it was a good opportunity to add to my position a bit. I think I was at 14 shares, so I went up to 16 shares here. Weighted average still up 15%. Would really love to get this closer to 20 shares, but it is a bit of an expensive company here because it grows so fast, because it has such great margins. Taking a look at their business here a bit, just in the last quarter, over 7% revenue growth, 300 basis points of operating margin growth, and EPS growth over 20%. And if you just look at their businesses here, they have huge moats in these businesses. Indices, they obviously own indices like the S&P 500. So whenever companies like even here, Vanguard is selling me an S&P 500 ETF for 5 basis points or 6 basis points of a management fee, probably almost half of that or a good chunk of that goes to S&P Global. And that just flows right through into this $927 million of operating profit that they had on their indices business. Market intelligence, big data continues to become more and more prevalent and necessary for investment decisions and hedge funds and whatnot. And that's been a really great business for them. They acquired that a number of years ago. And then credit rating is obviously a duopoly for the most part between them and Moody's. They have some other businesses like Commodity Insights and whatnot that they also have pretty good moats in. So they have a lot of businesses, all high margin, all pretty strong moats in. And that's why this company trades at close to around a 30 times earnings multiple. It kind of sucks to buy them at these levels, but historically, if you look, they've really been able to still compound their earnings really well. And people who bought at a 30 times earning multiple, 5 years ago are probably closer to a 15 times their buy-in price just 5 years later. So I'm betting that they're going to continue being able to drive that level of value. Going on to the Canadian side, some other stocks I've been buying on my Canadian side. Dream Industrial REIT is one that I've been buying pretty heavily. I don't have a ton of shares in this actual account here, about $1,000 or 80 shares at a weighted price of $13.30, so I'm down a bit on that. But I have been buying more heavily in my TFSA, my RSP, on this name here, trying to be a bit more cautious as I'm adding new positions to my dividend portfolios, where to hold different types of non-eligible, eligible dividends. REITs is definitely one that it looks like it's much better to own in registered accounts. So I've been trying to primarily buy them there and move them over there where possible. I still have about 80 shares here though. Looking at this one, they did funds from operation, I think it was around 85 cents in 2023, and they grew that at a pretty good clip. Lots of other REITs are not really growing their funds from operations over 1-2%. Some of them are going down. Dream Industrial has been growing it at a pretty good level, and I think they have a growth forecast for 2024 as well. So if I said they're going to do 90 cents in 2024 as an example, then this stock's trading at about 14 times current year earnings here. They pay out a nice 5 to 5.5% dividend yield, which gets paid out on a monthly basis. And they also have operations both in Canada as well as Europe. So you're getting some international exposure here. Taking a look at just their fact sheet here, you can get a good sense for their FFO per unit growth was over 10% in the last quarter that they did this. Their net asset value per unit continues to go up. I know this isn't a perfect metric, depends on accounting and how they're valuing their properties, but that's also giving me a nice margin of safety that I'm buying at under 13. They're saying that their value per unit is closer to 17%, $17 rather, and it's gone up pretty significantly over the last 5-6 years. So they've been pretty good at creating value. They have pretty low interest rates here, so that's great, but it's also a bit of a headwind into the future as those rates come up for renewal and that debt has to be resourced. So that's just like a watch out. They operate in a lot of different industries. So logistics, obviously, as an industrial and warehouse company, makes a lot of sense, but a lot of other areas as well, pretty well diversified there. I wish they showed their geographical presence, because it's actually one of the things that I like about this company in terms of their exposure. Oh, they got it up here. So you see here they have about $5 billion of assets in Canada, $2.4 billion in Europe. So I think that's predominantly Spain. They have some in Amsterdam, those kinds of places. And then they have an interest in a small, like not a small, but they have about a 25% interest in $1 billion portfolio in the US, so worth about $300 million. That I don't think they manage that directly, but just to give you a sense of the company a bit. So this is one. Right now I have a lot of retail REITs. I have some residential. We talked about Allied in terms of office. Industrial is one that I think is one of the few growing asset classes in terms of REITs earning power. So I want to have some exposure there. So building this one up across my accounts as well. And then one other one on the Canadian side that I've been adding to a bit is actually Fortis. So I'm trying to find it here, but Fortis has been one really steady performer over a number of years. It's been trending down over the last couple months. So you see here, last 3 months, which is essentially year to date, down 5%, getting a 4.4% starting dividend yield. They increased the yield about 6% a year. So just continuing to build on that snowball of owning more shares, each of those shares paying me more a year. Pretty stable company in my opinion. I don't think it'll get knocked off anytime soon, given the regulatory and regulated nature, of their revenue and earning stream. So that's when I've been building up a tiny bit. In terms of stocks that I'm looking at or considering here as we look into May and the rest of the summer, a couple names on the Canadian side that I have on my list. One is Rogers. Rogers has dropped off a bit of a cliff lately. Looking at it the last 1 month, down 10%. Couple hypotheses. One being they do have a lot of debt, and I think investors may have been counting on lower interest rates to come and hit sooner, and it doesn't look like that's happening as soon or as low as investors initially thought. In addition to that, there's been some news in Canada about more consumers adopting streaming and that trend accelerating. So Rogers obviously has a pretty notable size cable business, and that's probably hurting them a bit. What's interesting is Rogers over the last, let's call it 5 years here, down 25%. Going over to a company like Bell, which is one of their direct competitors, but I believe a much bigger cable provider, over the last 5 years. Oh, you know what? Down about the same amount. I thought it was going to be a bigger number on the Bell side because of their cable exposure, but doesn't look like that's the case. Nonetheless, Rogers is paying about a 3.5% dividend yield. They have a really good wireless business that's very attractive margin-wise and reach-wise. So it's one that I haven't continued to buy recently, but one that I'm keeping an eye on, especially as it gets closer to that $50 range, as I think they have about $5 of free cash flow per share. Other stocks on the Canadian side, TD Bank's one of my biggest positions. Whenever it's around $80 here, trading at under 10 times current year earnings, it's one that I'm interested in nibbling on if there's nothing more attractive in the market for me. You can see it's really traded sideways over the last year or so at $80. I think they're going to do about $8 or $8.50 of EPS this year. So overall, in a pretty good spot on that front. And then going into some other stocks I'm looking at on the US side here. I've been buying Coca-Cola, got up to 250 shares. McDonald's is one that has been going down recently for a number of reasons, lots of boycotts and whatnot affecting the company. In addition to that, they dropped a bit off of just like Ozempic rhetoric around how consumers will be eating less junk food, be less hungry, stuff like that. Anyways, pretty big drop in the last month, about 10%. Long term, you can kind of see the company's been very resistant on bouncing back from these drops. And it's really hard to get McDonald's at a good valuation just because they are such a beloved brand, generally speaking, globally, and just the most productive fast food brand and chain in the world. Taking a look at their earnings estimates, about $12.50 this year, $13.50 next year. So if I took $12.50, they're trading right around 21 times this year's earnings. And then if they're going to actually grow close to 10%, they'll be actually 19 to 20 times next year's earnings. So getting McDonald's at under a 20 times multiple, assuming you think at some point things will go back to normal, and this Ozempic train will not actually suppress appetites to the extent or at the scale that will actually meaningfully impact McDonald's growth rate or business. It may be an interesting time to buy. They actually just did an investor day a couple months ago on their growth profile for the next 5 years, wanting to grow tons of restaurants, particularly in the U.S. They see a lot of opportunity in areas of the country that have gotten more populated and that they feel like they're underdeveloped versus where they should be. So we'll see how that comes to life. But I like the fact that they're going on offense. They have a growth plan. At the same time, investors are kind of reevaluating their stock downwards a bit, potentially off of kind of more short-term drivers. So those are some of the names that I'm looking at in my stock portfolio here. Let me know your thoughts on the companies that I talked about today or any other stocks that you may be buying. Would love to talk about them and interact with you guys in the comments. If you guys made it to the end of the video, thank you guys so much. Really appreciate it. And I'll see you guys in the next one.